Welcome to our channel. In today's video, we'll be diving into the world of peer-to-peer, P2P lending platforms, exploring how they work, the benefits, and the risks involved. Whether you're considering lending or borrowing, this video will provide you with a clear understanding of this growing financial trend. Don't forget to subscribe for more insightful content. Number 5. What is P2P lending? Peer-to-peer P2P lending is a financial model that connects borrowers directly with investors, bypassing traditional financial institutions like banks. In this system, individuals or businesses seeking loans can apply for funds through a P2P lending platform. These platforms serve as intermediaries to facilitate the matching of borrowers and lenders. But unlike banks, they do not provide the capital themselves. Instead, the money comes from private investors who choose to fund the loans. The primary goal of P2P lending is to offer an alternative to traditional banking channels, providing access to loans for individuals and businesses who might not otherwise qualify through banks. Borrowers can benefit from competitive interest rates, while investors have the opportunity to earn interest on the money they lend. The platforms typically assess the creditworthiness of borrowers through algorithms and third-party data, which helps to determine the risk involved in each loan. Investors can diversify their portfolios by funding multiple loans across different borrowers, reducing their overall risk exposure. Overall, P2P lending offers a streamlined process that eliminates the need for banks, providing more flexibility and potentially better terms for both borrowers and investors. Number 4, how it works? P2P lending works by creating a marketplace where individuals or businesses seeking loans can connect directly with investors. The process starts when a borrower submits a loan application on a P2P lending platform. The platform evaluates the borrower's creditworthiness through a range of factors, including their credit score, income, and financial history. Once the borrower's details are verified, the platform presents the loan request to potential investors. Investors can review the borrower's profile, including the loan amount, term, and the risk involved, before deciding whether to fund the loan. The funding process often occurs in small increments, with multiple investors contributing to a single loan. Once enough funds are raised, the loan is disbursed to the borrower. In return, the borrower agrees to repay the loan, typically with interest, over a predetermined period. Investors then receive monthly payments, which include both principal and interest. The platform generally handles the administrative tasks, such as payment collection and disbursement. Investors benefit by receiving interest on their capital, while borrowers enjoy lower interest rates and more flexible lending terms. P2P lending platforms usually charge a fee for their services, which is typically a percentage of the loan amount or the repayments received. Number 3, benefits for borrowers. One of the primary benefits of P2P lending for borrowers is the potential for lower interest rates compared to traditional bank loans. P2P lending platforms often offer competitive rates because they operate with lower overhead costs than banks, which allows them to pass on the savings to borrowers. These platforms use alternative credit scoring models, which may be more lenient than traditional credit scoring, offering individuals with less than perfect credit a better chance of securing a loan. Additionally, P2P lending platforms typically have a faster and more streamlined application process than banks, reducing the amount of time it takes to receive funds. This quick access to capital can be particularly advantageous for borrowers who need urgent financial assistance. Furthermore, P2P platforms often provide more flexibility in loan terms, such as repayment schedules and loan amounts, which can be customized based on the borrower's needs. This level of personalization can make borrowing more manageable and less stressful. P2P lending also provides an opportunity for individuals or businesses who may not qualify for a traditional bank loan to access credit. Overall, these benefits make P2P lending an attractive option for borrowers seeking lower costs, faster approval times, and more flexibility in their borrowing arrangements. Number 2, benefits for investors. Investors are attracted to P2P lending platforms because they offer the potential for higher returns compared to traditional investments, such as savings accounts or bonds. While the returns on P2P lending vary depending on the risk level of the loans, they can be significantly higher, often exceeding the interest rates offered by banks or other conventional financial products. Investors can choose the types of loans they want to fund, from personal loans to business loans, allowing for a more customized investment strategy. This level of control over the investment portfolio is a key advantage. Moreover, investors can diversify their portfolios by spreading their investments across multiple loans with different risk profiles, which helps reduce the risk of loss. For example, by investing in loans to a variety of borrowers, investors can mitigate the impact of a single borrower defaulting. P2P platforms typically provide tools and analytics to help investors assess the risk of each loan, including the borrower's credit score, loan term, and default rates. Many platforms also offer auto-investing features, where investors can set criteria for the types of loans they wish to fund, and the platform automatically allocates funds accordingly. This ease of investment, combined with potentially higher returns, makes P2P lending an appealing option for investors seeking to grow their capital. Number 1. Risks involved. Although P2P lending offers various benefits for both borrowers and investors, it is not without risks. The primary risk for investors is the possibility of borrower defaults, where the borrower fails to repay the loan as agreed. Unlike traditional bank loans, P2P loans are not typically backed by collateral, making it difficult for investors to recover their funds in the event of a default. The risk of default can be influenced by the borrower's creditworthiness, but even well-qualified borrowers can face unforeseen financial difficulties that lead to late payments or non-payment. P2P platforms generally attempt to mitigate this risk by assessing borrowers through credit scoring and offering various loan categories, but there is always a degree of uncertainty. Additionally, P2P lending platforms are not insured or guaranteed by the government, meaning investors have no recourse to recover their funds in case the platform goes out of business. For borrowers, the risk is primarily related to higher interest rates or potentially stricter terms if they are unable to meet the repayment schedule. In some cases, defaulting on a loan can also have negative implications for a borrower's credit score. It is also important for borrowers to consider the risk of fees, which can vary depending on the platform. Thus, both borrowers and investors need to carefully assess the risks before participating in P2P lending. Thank you for watching. We hope this video helped clarify how peer-to-peer lending platforms operate. If you found it useful, make sure to subscribe to our channel for more videos like this. Your support means a lot,